And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The spike in crude prices off a coordinated attack on Saudi Arabia's oil supply has energy stocks rallying big, along with energy ETFs. But buyer beware, this is a hollowed out, heavily shorted sector of the market. You might be surprised at what exactly you're buying. That's a favorite theme here at ETF Edge, joined today by Todd Rosenbluth. He's the head of ETF and mutual fund research at CFRA. Tom Lydon, who runs ETFtrends.com. And Tom, the important thing here, I say hollowed out. We like to talk about ETF volume. Today we're getting very big volume in these energy ETFs. The XLE, which is the biggest energy ETF out there, the S&P, has got huge volume. Yet when you look under the hood at what this actually is today, 45% are two stocks, Chevron and Exxon. Two stocks in a sector in the S&P. I've never seen that, and it speaks to how hollowed out this sector is. Everything else is down so much that the two big guys left basically are the market at this point. Your thoughts on what somebody who might be interested in rotating into these energy ETFs what's the right way to look at this?
Well, the ETFs that you brought up, it covered three areas, Bob. USO, which is spot crude itself.
Oil.
So if you just do not want to mess with the companies, you can buy oil. On the other hand, you can buy those big energy companies, or you can buy the services companies with Halliburton and Schlumberger, where that's actually up greater today. It might be that those companies are going to be brought in to help prepare
and that would be
help out.
OIH is
that's
the symbol
correct,
there.
right?
Yeah. And Todd, there's also energy exploration and production companies. Seeing some of these Permian and Bakken companies, small Bakken companies, do very, very well today. That symbol is XOP for that ETF. I guess the problem I have, I know you're not an oil stock analyst, but is there any reason for a person interested in moving money around through the ETF ecosystem to consider one of these sectors at this point, given how hollowed out energy is in general?
Well, I work with them at CFRA, and so our equity analytical team put out research today. Stu Glickman heads that up, and we are more favorable on the exploration and production companies. And some of these smaller cap companies that you mentioned earlier, higher debt leverage, weaker cash flows, this has really been a boost for them, a jolt that was unexpected from a supply perspective, and this could take a little bit of a while. You also have exposure to value ETFs, have exposure to energy, so IVE and RPV are some of the value slices of the S&P 500, where the energy exposure is higher than what you'd find in the S&P.
You know, Tom, I don't think people understand how different the world is now, even than 10 years ago, but certainly than in the 1970s, when the energy was more than 20% of the S&P. Today, it's 5%. We're only down 0.5%. If this would have happened 10 years ago, even 10 years ago, we would have been down 500, 600 points, I think, on this. And yet the energy independence that the U.S. has been slowly gaining, we are the largest producer of oil in the world, I think it's really mitigated the effects of this. I'm not trying to downplay it, but certainly we would have seen a more dramatic response 10 years ago.
But big question is, Bob, going forward, is it one and done, or are we going to see more? And a lot of investors out there are thinking that might be the case, so they're actually leveraging up through some 1, 2, 3 times ETFs that are available. And again, it's a short-term trade.
I want to move on, but is there any reason to believe, talking about what he says, is there any reason to believe that oil company profits in general are going to be any higher in the next couple of years because of this event? That's going to be the key question for a long-term investor. Is there any reason to be optimistic about that?
Right. Well, supply and demand is obviously the key thing that happens within the energy space. So now we've seen supply come off a bit. Demand is continuing to do well. If we see the global economy strong, we could see that continue. Okay.
I want to move on here because we're in a very interesting subject today. ESG. That's environmental, social, and governance. And it's taking the ETF universe by storm. But while many investors are getting into this space, it's important to look under the hood and know what you're buying. So for instance, this is one thing we've been talking about for a couple of weeks. One fund that launched a few weeks ago has a very enticing name. It's the Vegan Climate ETF. Sounds great, doesn't it? It excludes companies that rely on animal exploitation, that test products on animals or use animal-derived products. Okay. They also exclude companies that use fossil fuels, make plastics, or produce agrochemicals. Fair enough. What's left? Well, they do have Beyond Meat in it, but guess what the biggest holdings are? The ETF holds Microsoft, Apple, Facebook, and Intel. Who knew they were vegan? In short, this looks kind of like an ESG ETF, but the title doesn't really tell us what it holds. Tom, your thoughts? We have talked about this before. We did this with the Bitcoin ETFs. There was nothing to buy, so all of a sudden you ended up owning obscure semiconductor stocks that were only peripherally related. Yeah. I'm not trying to give them a hard time, but
no,
Microsoft?
But there's a big battle in the ETF space. Everyone's battling for assets. I think there's a lot of marketing. There's a lot of hype. There aren't that many publicly traded vegan companies out there where you can actually make up an index.
So this is part of that process of exclusion. We take stuff out rather than put stuff in. And it's fine. I understand the goals of it. It's just you didn't think you'd own Microsoft, in a vegan climate ETF.
Right, so the name on this tries to get you in the door, but when you finally look under the hood and you see what's there, you might be quite surprised. So exclusionary ESG-oriented ETFs might kick out companies like Exxon or Chevron that we talked about earlier, have little to no exposure to energy or utility companies. But what we're finding more and more is that ESG products that are coming to marketplace are more sector diversified, and so it's the best ESG companies that have ESG criteria within that sector. And so that's where we're seeing a lot of the money go as we've seen assets.
You know my point here. Everybody just know what you're owning here. And I have nothing against the concept. It sounds fine to me. Just know what's going on. I want to dig deeper into this ESG explosion. It's a broad term, but ESG basically involves looking for companies that meet positive standards of corporate responsibility. That's fair. That's not the only definition, though. Let's talk more about this with Luke Oliver. He's the head of index investing for the Americas at DWS Group. They have their own group of ESG ETFs. Luke, thanks for joining us. I guess the question is, it's a hot topic. Everyone wants environmentally responsible, socially responsible ETFs. How much interest is there really out there, and how do you sell this to the investing public right now?
Well, first of all, thanks for having me on. It's a really interesting topic. We've seen this growing trend, growing appetite for ESG, and we've seen it actually more in Europe. Currently, there's about 124 billion tracking ESG strategies in Europe, ETFs in fact, and in the US, we have 50 ESG products tracking about 12 billion, which has doubled over the last year or so. So certainly some momentum behind it. Now, how you sell it is very different to the product you mentioned a moment ago. We're not looking for a theme on a particular element of the environment or social or governance. We're actually looking at this across all of the sectors. And the way to really get a good investable product that can really be something you can use as a core strategy is something that gives you a like return to the market, like risk, and core pricing, which has been the turnoff that a lot of people have expressed in the past.
Well, I guess here's the problem I have, guys. He mentioned 12 billion. It's a $4 trillion business in the United States. It's pretty small. I guess, why is it so small? Why is it so hard to sell this when everybody believes in social responsibility? So we have environment, positive impact on the environment, social, good relations with employees and customers and stakeholders, governance, looks at leadership, looks at pay, looks at shareholder rights. Hey, I'm in favor of all that. I'll sign on. Why isn't anybody buying into this right now?
Well, it's going to get traction, and I think we both agree. There's, as Luke said, there's a huge amount of following over in Europe. We have a generation that's growing up right now that is really adamant about sticking with this type of investing. And going forward, we're going to make sure, and I think collectively in the ETF space is all going to be a part of it, that if you are not sticking to these standards, and these standards are kicked off by the UN, which is meeting next week with the Climate Week. We have major indices and indice providers that are getting together with the UN to set these standards. It's all about education, and I think we're just getting started.
Do you think this is going to make a difference long term in moving the needle on corporate behavior? I'm asking a different question. Instead of, why aren't they selling as much, do you think long-term this actually will make a difference?
Absolutely. I mean, the first thing is that there's a transfer of wealth to the millennial generation that have been recorded as saying they want 90% of them expect to invest through this type of socially and aware responsibility. So seeing that trend, and the fact that we're seeing something like 30 trillion is going to move from baby boomers to millennials over the next 20 years really means that companies are going to have to sit up and take notice of it. But,
go ahead.
Well, there's a key misconception, I think, that people are falling into, that ESG means that you're stepping away from performance and making some activist play, when in fact, what ESG is all about, as you said, is companies that are responsible with their supply chains and their employees, companies that have good governance around corruption, data usage, and with, as far as the environment, responsible use of renewable energies and things. So these aren't activist sentiments. These are good, solid investments for the way the world's developed.
You're not having to give up performance.
You're not.
Well, that's a good point. So let's just look at one of your big ones, USSG. That's the X-Tracker Leaders ETF, the ESG Leaders. That is tracking the S&P closely this year. It's not underperforming, is that right?
It's tracking in line with this. The USSG tracks the MSCI USA.
Yeah.
We also have S&P that tracks the S&P 500.
That's right.
Both of those have low tracking error to those underlying benchmarks.
Just so we're a little less abstract on this, I want to put up, if we can, the top holdings for USSG. This has got I chose this because it's yours, and it's got $1 billion in assets under management. But your top holdings: Microsoft 7.5%, Alphabet 5.5%, Johnson & Johnson 2.6%, Visa 2.3%. This sounds like all the really high quality large cap names. Mm-hmm. Can you briefly explain how you end up in a top holding with a big? Microsoft has a really large concentration. Yep. Can you articulate why Microsoft meets the standards?
Yeah. Well, first of all, you mentioned another fund before that had a niche theme, and then it picked stocks, and you ended up with a bunch of tech stocks, and you couldn't tie back those stocks back to why that theme. What we're trying to do is give you a performance like the S&P 500 or the MSCI USA. So our objective is to look like those, but to be aware of the E, S, and G. So companies that, in fact, I'm surprised you picked on Microsoft, but there are some energy companies still make it into these benchmarks. And why that's particularly interesting is because you would think energy company, that's got to be bad for the environment. But these companies spend more than some of the biggest spenders in renewable energy.
Can you give us an example? What's an energy company that's in the ESG?
Well, if I take S&P just for example, Exxon is one of our larger holdings for exactly that reason. When you look at we want to have the energy sector in there because it's important that we give investors something that tracks like their benchmark. So we want to pick the best ESG stocks, and Exxon.
So you can actually make an argument that Exxon, this is pushing it, environmentally responsible. Maybe I'm pushing it too hard, but at least satisfies criteria of an ESG stock. You can make that argument? I'm asking.
We make the argument that you want to have energy in your portfolio for exactly as you mentioned today. You've seen Chevron and Exxon perform very well. If somebody took those out, then you would underperform, and we'd be back to that problem of underperforming ESG. So we pick the better ESG scoring energy companies and the better ESG scoring tech companies and so on. So we screen some out, but we keep them so that we can keep neutral to that sector.
Yeah, and here we're putting up what's in SNPE here, and you see Microsoft, Apple, Amazon, JP Morgan. I noticed Apple was not in the USSG, but it is in this one. So this gets to this question: how do you slice and dice these? It mystifies me somewhat.
Well, yeah, so in this case, S&P is a smaller. S&P 500 is less stocks than the MSCI USA, so you get down to some different ways of cutting things off. Apple, for example, we've often heard some questions around, employees and things like that.
We only have a minute left before I let you go. The cost. These are low cost relatively, right? Am I correct? What are we talking about basis points for the S&P?
11 and 10 basis points.
11 and 10. Okay.
So the idea is...
So that's competitive with the S&P.
And I think that's what's going to help people come in the door. So people have historically thought it was a premium product in ESG, but now the costs have come down and they're more likely to come and take a look at a product.
And you've been sort of quiet on this. Do you actually... I'm still mystified why they can't sell it that well. I know he's trying over there. He's doing his best and there's more. But why don't people go... This seems right to me. Why isn't there a lot more assets in this group?
I think, these two products that he's been talking about and a couple other ones from iShares and Vanguard have all come out in the last couple of years. Investors are getting educated about these products. We at CFRA really think there's going to be strong growth within ESG over the next 3 years.
Okay, so you're bullish. Last word?
Well, we've launched 2 ETFs this year and we've raised $1.5 billion in them, so I think we're starting to see that momentum. Yeah,
there's definitely some interest there. Thank you. Very interesting discussion. Appreciate you coming on. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom, to Todd, and to Luke for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday. Same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.